Permabull investor Tom Lee is calling for a correction in the first half of 2026, followed by a massive recovery, and he believes we're going to end 2026 positive 10%, which would be very surprising to me. But I decided to take a look at his portfolio, mainly his ETF, and look at his top three holdings. And to me, they are very, very interesting stocks, especially the first one. It's a very interesting one, a bet on electricity and data centers in general with a wide moat, a competitive advantage. So I really love those stocks and want to talk about them and analyze them today and give you my fair value on each one of them and my thoughts in general. The first one is GE Gernova, ticker symbol GEV. This was a spin-off from GE General Electric, and it's been a very successful spin-off so far, but it's really an amazing company. Now, GEV mainly installs and manufactures heavy-duty gas turbines, which mainly are used to generate electricity. I believe they boost electricity output by, I think, 20 or 25%. But electricity is a massive mega trend in the United States, not just from a lot of immigration that's coming in and the more and more population in general, and we have an old grid, but we also have the data centers, which consume massive amounts of energy. So energy in general, especially electricity or anything related to the grid, power generation, this is a major mega trend over the next 5 to 10 years. And Tom Lee is playing it with GEV, which I believe is a genius bet. Now, what makes it very special is once they install those gas turbines, they need to maintain them. They need tons and tons of maintenance, and it's like a recurring revenue business model in a way, where once GEV install those gas turbines, those kind of utility companies, they can't just call another company and then, hey, can you come fix that gas turbine? They have to use the parts that were made by GEV, and GEV pretty much has a moat around it where they can charge whatever they want, and they're going to be collecting those revenues. Kind of like the elevator companies. Once they install an elevator, you kind of have to keep calling them to maintain the elevator, and you can't go to somewhere else to get the same exact parts because they are manufactured by the elevator company. So this is really an amazing, amazing business. It's CapEx heavy in the beginning to do a lot of those research and development, but once they're installing the turbines, then they collect recurring revenues for the next 10, 20, 30 years with no competition and massive pricing power. The company is also getting into SMR. I believe this is small modular reactors, and they've been doing a lot of things within nuclear, and I believe that's going to be the first one in North America. It's going to be in Ontario, I believe, and that's pretty amazing for the company. The company is rapidly growing in revenues. Adjusted EBITDA margin is expanding from 2.4%, 11 to 13%. Free cash flow is also booming for the company. The backlog for 2028 is expected to be $200 billion. This is more than 5 times their current revenues of $41 billion. So the backlog is massive, and they have a lot of visibility well into the 2030s. And once they install them again, it's going to be all recurring revenue, maintenance, and recurring fees, and massive pricing power. And I really, really love the business model, and I never analyzed it before, which is why I'm very excited to talk about it. Now, in terms of my valuation model, if I look at the company's outlook, they are guiding for $52 billion for 2028 and a 20% adjusted EBITDA margin. Okay. Now, for overall revenue growth, they are guiding low double digits revenue growth. So for my 2030 price target, because I like to value stocks over the next 5 years minimum, and I like to get it double over the next 5 years, I put in the 52 billion expected for 2028. Then I put in for the next 2 years 12% of revenue growth, which is low double digits. I believe this is very, very fair. In total, I got $65.23 billion in revenues by 2030. And if you remember, the EBITDA margin guidance was about 20%. So if we take the 20% EBITDA margin, we end up with $13 billion in EBITDA. Now, in terms of a multiple, there's a lot of ways to think about it, but I believe the company is extremely overvalued here at 75 times enterprise value to EBITDA. 75 times is absolutely crazy. Now, EBITDA is expanding rapidly, not because of revenue growth. Revenue growth is like 12, 13%, but it's mainly the margin that is expanding because they are expanding their services revenues. So forward enterprise value to EBITDA multiple is at 36 times enterprise value to EBITDA, which is much better than 75 times. But 36 times is still outrageous in my opinion. And I believe over the next 5 years, the company would have already expanded their margins in a major way. So there's not going to be a lot of room for more you could say margin expansion after 2030, and it's going to be a revenue growth story, which is 10, 12, 13% a year. So I would expect a massive multiple contraction. So for my estimate, I'm using 25 times EBITDA and 30 times EBITDA. If I use 25 times EBITDA, I get $326 billion market cap. The current market cap is $178 billion. This is only 82% on the upside for the next 5 years. Pretty much no margin of safety at all. If I use 30 times EBITDA, which I believe is a little bit more fair, and I think it's still somewhat expensive. Normally those stocks, they trade 20, 21, 25 times, but even 30 times, I got 119% on the upside over the next 5 years, which is really not bad at all, but it's still really not enough for me in terms of a margin of safety. I'm still betting on 30 times EBITDA, and I'm betting on everything going right within the company. So while the company is amazing, I believe the stock itself is overvalued. And for me personally to buy the stock, it would have to be trading around $500 or a little bit under $500 per share. That would be at about a 22, 23 times EBITDA multiple. And I would be getting some kind of a margin of safety in case something goes wrong, something doesn't play out. If it gets there, I would be a very happy buyer. Now, the second stock that Tom Lee owns is PNC Financial Services. The stock is up 9% year to date, and it's barely up 1,000% since they went public in 1985. I mean, even art or silver or even the meme coin, they have outperformed PNC. It's been a terrible performer, but Tom Lee holds it for a reason, and I believe he's holding it, or mainly actually based on his own presentation, he's owning it because of easing financial conditions, and you can see it on the graph. This is PNC Financial Services. So once the Fed is lowering interest rates and is easing financial conditions, there are certain banks that will benefit a lot from that, and this is mainly banks that are growing in non-interest income in a major way. There are some banks that are only dependent on net interest income, and they would be hurt if we have easing in financial conditions. But PNC is mostly focused on non-interest income, and despite interest rates being elevated, the interest rate income grew 7% year on year, but non-interest income is growing 12% year on year. So this is very impressive, and they are rapidly expanding their non-interest income. The company is also very diversified. They have retail banking growing 9%. I'm very impressed, actually. I never thought of that. They have corporates and others growing 10%, and they have the asset management group, which is growing 9% year on year, and they have very sticky fees, recurring revenues, and those are growing 5% year on year. Very impressed, guys. I never looked at the PNC Financials. Now, in terms of their credit profile and a lot of their, you could say, defaults or non-performing loans, they're barely 0.65% of the total loans. So it's a very small percentage that didn't do too well. And this percentage has gone down year on year, which is something that's very positive for the company. Now, normally for banks, you would value them on a price to book ratio. But here I'm going to use a PE ratio, as I believe it's a little bit more appropriate. And the PE ratio for PNC is about 12 times. 12 times earnings, guys, is very cheap for such a company that's growing revenues in this magnitude. But again, PE has always been cheap on PNC. It's been 12, 13, 14 times. And normally those regional banks, they get a multiple expansion whenever the Fed is easing rates, which is why another reason for Tom Lee to buy it. But I still believe 12% or 12 PE is undervalued for a company that's growing 15% in earnings per share this year, expected to grow 11% next year and 10% the year after. It looks very undervalued to me. And this is the dividend yield. The company pays a 3% dividend, which is great. And it's well covered because the free cash flow yield is about 6%. So this is a little bit under a 50% payout ratio. So I'm seeing, a pretty decent return from PNC at 12 times earnings. You get a 3% dividend, and we're getting about 10, 11% of earnings per share growth. So this is 10% EPS, 3% dividend. This is 13, 14% annual return, excluding a multiple expansion. With a multiple expansion, it could be much more than 14, 15%. So to me, this is another very interesting bet that I never looked at before, and I wanted to talk about it and share it with you. And by the way, I'm using fiscal.ai to come up with those charts. If you want to try it out, they give you 2 weeks of free access if you use my link in the description. Now, the other stock is Tesla. And I have to be honest, guys, I really don't want to analyze Tesla because it's a very hard stock to analyze. I don't know what robo-taxis will do to them. I cannot estimate the TAM. I cannot estimate the percentage of revenue. I would be speculating. And Tesla is a stock that I always regarded as a futuristic bet where you own it and a lot of good things could happen, a lot of things could go wrong. So if you're valuing it on the present and their loss of market share in Europe, I don't think you're doing it the right way, but it's also hard to value it for the future, which is why I avoid Tesla altogether. But if I look at the price to sales ratio at 15 times, this is as high as it was back in 2021. And that doesn't make me too excited to buy the stock, which is why I'm going to analyze instead the fourth stock, which is one of my favorites, and this is Meta. Meta is a decent percentage of my portfolio personally. The stock is down about 5% over the last 6 months. It's not going down because the company is not growing in revenues or because the business is not doing too well, but it's mainly because of CapEx fears, and the CEO is increasing CapEx in a major way, not just in 2025, but it's going to increase much more in 2026. And a lot of market participants believe that this is going to be another metaverse moment where Mark Zuckerberg is flushing hundreds of billions down a toilet and is going to be wasting shareholders' money. But I don't believe it's true. I think he learned his lesson. And he said it himself on the latest earnings call. He said, we're also building what we expect to be an industry-leading amount of compute, which is around super intelligence. He doesn't know when it could come. It could be 5 to 7 years. It could be within a few years. But he said if it takes longer, then we'll use the extra compute to accelerate our core business, which continues to be able to profitably use much more compute than we've been able to throw at it. And in the worst case scenario, we were just slow building new infrastructure for some period while we grow into what we built. So the money that he's spending is mainly on compute, mainly on a lot of data center related stuff and compute related stuff. It's not going anywhere. The core business will be using a lot of it. But what a lot of investors are missing is that those AI related capex are being financed by AI generated revenues. So the company is not just throwing money again in the toilet and they're not getting any returns from AI. They're getting massive benefits from AI. And this is a recent article from Morningstar. And it says AI has helped supercharge Meta's core advertising business. Meta's annualized revenue run rate for its AI advertising tool is more than $60 billion. $60 billion annual run rate just from AI. It says, according to the latest earnings call. That means that Meta is already, via these AI tools, covering the incremental $60 billion in CapEx for the AI build-out between 2026 and 2024. So the company did invest in AI. They got $60 billion of annual run rate in revenues just from AI alone. So now the CapEx is covering itself, yet the stock is going down because people believe Mark Zuckerberg and they have recency bias from the metaverse and all that stuff. But all of this is over, and this is something entirely different. Now, something else that I predict will happen in 2026 is that Meta will be number 2 or mainly number 3 in terms of the generative AI market share. Now you have OpenAI, of course, which is ChatGPT. Then you have Gemini from Google. Then you have DeepSeek and Perplexity and a few others. You don't have Meta AI. Meta AI is not even showing up on the chart. But I believe Meta AI could possibly be the second or third largest AI platform in 2026, and no one is really expecting that. Now, if you look at what Mark Zuckerberg is doing, he's hiring a lot of AI talent, with the latest one being from Apple, which is going to lead the Meta super intelligence. And there's, again, a lot of hiring that's happening around Meta. Now, there's something else that's happening with Meta, and this is the advantage that Meta has over ChatGPT and over all those players, is that Meta has over 3.5 billion daily active people. 3.5 billion. And if you combine it with those amazing talent that Mark Zuckerberg has been hiring, don't you believe the Meta AI platform will likely be a much better platform in 2026 and 2027? I believe it will be. But the trick is that Meta does have access to 3.5 billion people. as I showed you. So if, let's say, you're chatting with your friend on WhatsApp, or people are chatting on WhatsApp, which has billions of users every single day, why would you go to ChatGPT, exit WhatsApp, go to ChatGPT or Gemini, research something or do your project, and go back to your WhatsApp group to chat with your coworkers or chat with your friends? Why would you do that if the Meta platform was actually great? If the Meta platform was actually great, you would stay within WhatsApp, you would chat with the Meta bot, and you would get whatever you want from the Meta bot, and Meta can advertise things to you, and they can fix all your problems. So if they just work on the bot, then people don't need to exit WhatsApp to go to Gemini or ChatGPT. They don't need to exit Instagram for them to go to ChatGPT or Gemini. Meta can integrate Meta AI within Instagram, which they've been doing it with a lot of translation, but they can even do much, much more. And they can integrate it within WhatsApp, monetize WhatsApp, 3.5 billion people every single day. And then Meta, I think, will be taking massive market share from OpenAI and Gemini. And this is why Mark Zuckerberg is spending all this money on hiring people. And I think it's a matter of time before they launch a record-breaking product that could potentially shock a lot of investors. But this is not my main case for investing in the stocks, not even my base case. To me, this is more of a call option. I started buying the stock at 20, 21 times earnings. It's trading at 22 times, and I still believe the stock is undervalued. 22 times is not expensive at all, especially relative to other stocks in the market. And Meta is rapidly growing. It's re-accelerating in revenues, and it's growing 26% in revenues. No other Magnificent Seven stock, I think not even Nvidia, is growing 26% in revenues and is actually re-accelerating in revenues. So I think the setup here is really amazing. Out of all of them, I would prefer Meta. I put it number one. Second one, I love GEV, but I would have to be around 500. And PNC is a great stock, but I personally don't invest in banks in general. And as you could tell from this chart, there's not really the best long-term investments. JP Morgan and a few others are the exception, but I try to avoid them. But that was my opinion on Tom Lee's 3 or 4 largest holdings. It was not financial advice, so I hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.